Good afternoon and welcome. I'm Susan Weber, your moderator. Thank you for joining us. And now I will turn the call over to Ted Patch. Ted has been with Walker & Dunlop for over 22 years and is the Chief Production Officer of our Multifamily Finance Group. Ted?
Thanks, Susan. Thank you for joining us for the Walker & Dunlop and Chatham Financial Libor Transition to SOFR webcast. As many of you know, the Libor index is being phased out and will be replaced by SOFR by the end of next year. This is a very significant event given that the Libor index is often called the most referenced short-term interest rate in the world. There are literally hundreds of trillions of loans, securities, and derivatives currently tied to Libor. It is the primary index that is referenced for most of our Fannie Mae and Freddie Mac floating rate loans, as well as other floating rate options in the market. With the transition to SOFR rapidly approaching, we wanted to provide you with the information you need to understand the potential impacts to existing loans tied to Libor and the new products being offered. Both Fannie and Freddie will soon be quoting floating rate loans over SOFR, and the specifics of those loan structures are now coming into focus. With me today are two people who are extremely knowledgeable on this topic and have been following the developments related to the transition since it was announced a couple of years ago. First is Blake Lanford, who is a managing director and co-head of our trading desk here at Walker & Dunlop. Blake has been with Walker & Dunlop for 8 years and was with CW Capital prior to joining us. We also have Matt Hoffman, Director of Global Real Estate with Chatham Financial. Walker & Dunlop has worked closely with Chatham over the years on defeasances and hedging, among other things, assisting our clients in purchasing interest rate caps for various floating rate transactions, including ARMs and structured ARMs. Chatham has been actively involved in the policy conversation for the Libor transition, sitting on various working groups and committees with the CFTC, ARC, and ISDA, to name a few, ensuring a borrower perspective is included in the dialogue and debate. Matt is a recovering lawyer and has been at Chatham for 8 years, so he possesses strong real estate, derivative, and financing expertise to help us dissect the issues inherent in the Libor transition. At this point, I will turn the call over to Blake to give us some background on Libor and the transition so far.
Thanks, Ted. For all those reasons, we can see the importance of Libor. Estimates suggest around 350 trillion in contracts globally tied to the index. How do we get Libor? It's a daily survey of panel banks to determine interbank lending rates on an unsecured basis across 5 different currencies and 7 tenors that range from overnight out to a year. These responses are meant to be transaction-based, but are often just expert judgment when there's little or no representative transactions. Unsecured borrowing is becoming a little less favorable, and Libor a little less representative market given the overall size. Transaction volume in USD Libor has tapered down to less than $1 billion per day, and some currency tenor combinations have had as few as 20 representative transactions per year that are of qualifying size. The integrity of these submissions is better today than it has been, but manipulation was a major issue, as we'll discuss in a minute. But before we start getting into the acronyms, a few key players. The Financial Conduct Authority, or FCA, is a UK regulatory body formed in 2013 under the purview of UK's Treasury and Parliament. The Alternative Reference Rates Committee, or ARC, is a group of private market participants formed in 2014 by the Federal Reserve Board and the New York Fed in order to identify a new reference rate and also put forth a plan or a PACE transition plan. The International Swaps and Derivatives Association, or ISDA, is a trade group organized in 1985 for those in the market for over-the-counter derivatives. ISDA has a standardized master agreement for its members, also maintains best practices, legal definitions, and among other things, is an advocate for its members. So to give you a brief history of Libor, the first transaction was an $80 million loan made in 1969. From there, it slowly grew in popularity until the 80s, where it was formalized and taken over by an administrator in 1986. Manipulation was rumored to have started in the 90s and became much more widespread by the Great Financial Crisis. In large part, bankers were understating the rate to improve their perceived creditworthiness. On a smaller scale, some bankers working with brokers were colluding for profit on their derivatives books. The scandal was suspected as early as 2009, but really broke in 2012. By 2014, the administrator was changed. Heavy fines were levied on banks into the billions, and several bankers and brokers went to prison over the scandal. But the reputational damage couldn't be undone. There was just too much at stake. The FCA announced in the summer of 2017 that it would no longer compel panel banks to report LIBOR after the end of 2021. Which brings us to the U.S. replacement benchmark. The Secured Overnight Financing Rate, or SOFR, was recommended by the ARC. SOFR is published by the New York Fed for the public good, as opposed to LIBOR, which was published by an administrator for profit. SOFR is based on overnight borrowing and treasury repo markets, which is the largest rates market in the world for these maturities. Repo, or repurchase agreements, are perceived to be risk-free. Borrowers of cash post U.S. Treasuries as collateral with an agreement to buy them back at a specified date. Maybe oversimplifying here a little bit, but you can think of repo like a pawn shop. This is completely transaction-based with daily volume in the repo markets close to 1 trillion per day. It's much more easily traceable and much more representative of today's funding costs. One thing that's common in SOFR markets or cash markets is spikes at month end and quarter end due to supply and demand dynamics in these cash markets. One extreme was last September, where the spot SOFR went up over 300 basis points from Friday to Tuesday. A lot went wrong that month, but this is not the norm. In addition, the ARC fallbacks start with term SOFR, which is currently unavailable. That would be similar to 30, 60, 90-day LIBOR. Instead, what we're going to be using is an average 30-day compounded average SOFR, which really smooths out some of these spikes that we see in the spot rate. SOFR was first published in April 2018. The CME Group launched 1 and 3 month SOFR futures in May of that year, which is an important first step in developing a forward curve, which is instrumental in pricing derivatives, among other things. The first pioneering transactions were in July of 2018. The first over-the-counter swap was cleared using SOFR, followed by the first SOFR debt securities being issued by Fannie Mae. So now I'll turn it over to Matt to further explain the development of these markets.
Thanks, Blake. So as you'd mentioned, the Fed began publishing SOFR back in April of 2018, and we've started to see futures activity pick up as well as swaps activity, but as we'll show a little bit later in the presentation, the numbers are nowhere near activity in the LIBOR markets. So while things are definitely moving up and to the right, so to speak, there still remains to be seen kind of how quickly the rest of these markets can develop for purposes of having as broad and deep a SOFR-based lending and hedging market as we have on the LIBOR transition side. And with that, there are a few deadlines that we are keeping an eye on, and we're going to talk through those in a little bit more detail shortly. But for one, we're expecting ISDA to release their revised definitions and protocol and related documentation to facilitate incorporating those through, I think they said it was going to be through the end of August, but it's been pushed to sometime in September rather. There are certain factors beyond their control that are holding them back from actually moving forward with publishing those. So that's one thing that we're going to focus on, and we'll talk a bit more about that shortly. There's also this clearinghouse Big Bang, where the clearinghouses that sit between dealers on their transactions are going to be changing some of their discounting methodology for purposes of valuing positions, and we'll talk a bit more about that a little bit later. That's happening in mid-October. And then we've also got the end of the transition, or the actual transition, set for the end of 2021. One question we've been getting a lot is, well, is LIBOR going to go away altogether as of that date, or will it continue to exist in some form or fashion beyond that? The answer is it remains to be seen. I think regulators would tell you that the rate is going to go away altogether, but there are certain what they call tough legacy contracts, these existing contracts that are practically challenging to amend from LIBOR to anything else in light of the fact that you would need 100% shareholder consent to do so. So there are certain solutions that the market is working on in order to be able to try to facilitate that, a legislative solution that's been proposed in the States as well as one that's been proposed in the UK. But Again, none of this seems to be really impacting anything in terms of the timetable, and we're going to talk about that a bit shortly as well. So with that, there are some of the events, both more concrete and abstract, that we're expecting to come up over the next, call it, year and a half at this point. And that's about it in terms of some of the things that we're keeping an eye on, Ted.
Okay, thanks. So we've been hearing about the LIBOR transition for what seems like a while now, and my sense is that some people haven't been following it very closely. So Blake, where do things stand now? And is it time for borrowers to really start focusing in on the transition?
Yeah, with respect to agency multifamily debt, we've long expected this to come in two phases, where the first phase is the conclusion of LIBOR-based loans and the start of SOFR-based loans for new production. The second phase is when the entire legacy book transitions from LIBOR to SOFR. So in this year, or in February of this year, the Federal Housing Finance Agency announced dates for phase one, basically instructing Fannie and Freddie to stop issuing LIBOR-based quotes or at least stop taking applications at the end of September 30th. And then those loans would have to be closed by the end of November in order to deliver the last LIBOR-based loans to the agencies by the end of this year. In May, Fannie and Freddie collaborated to issue a joint transition playbook, which covers a wealth of information in single-family and multifamily, both loans and securities. They also issued a large FAQ. Currently, the agencies are finalizing new products, but we're first starting to get a look at those. Our most common Fannie and Freddie ARM products will survive. That's the Freddie ARM and the Fannie Structured ARM, with a couple distinctions. Both Fannie and Freddie will be quoting SOFR on September 1st. But there's not a widely available cap market for SOFR right now. So Freddie's solution to this is to allow, on a temporary basis, LIBOR-based caps on the SOFR loans. Fannie is not going to allow the LIBOR cap, but they're going to allow the use of LIBOR or SOFR during the month of September until we hit that deadline. Another new product, if you're familiar with Fannie's ARM 7.6, which has an embedded cap, Fannie's going to be also adding an ARM 5.5, which would be a 5-year ARM, also with an embedded cap, and a 5-year extension option at the end, which is a new product feature. So with these new loans being rolled out, I think the agencies are in a good place for phase one. Just turn back to Matt now and looking at the big picture. Is this transition on track in your mind?
That's what regulators would have you believe, Blake. With that, we have seen certain, what I would describe as shifts in interim deadlines, but we haven't heard anything definitive from regulators that they expect there to be a significant delay in transition, specifically that there's an expectation of things continuing as expected, at least in terms of the longer term deadlines that have been set. With that, we have seen a few deadlines extended in the interim, which suggests that more potentially could be should anything change. So with that, the FHFA, who regulates the FHLBs as well as Fannie and Freddie, has already delayed an interim milestone, and that delayed date has actually passed, where they've gradually been reducing the extent to which the federal home loan banks can participate in and execute or purchase LIBOR-based transactions. There was a final deadline set for March 30th that actually was extended to June 30th of this year, but obviously then has since passed. Otherwise, across the pond, the FCA, who, as Blake mentioned, regulates the LIBOR administrator, and also the Bank of England, delayed the prohibition on issuing GBP LIBOR-based debt that was supposed to take effect in the third quarter of this year. It's actually been extended to the end of the first quarter of next year. So there's a 6-month extension there. Again, nothing definitive in terms of a delay to the broader timeline in the end of 2021, but definitely signs that there's flexibility there should market conditions demand it. Beyond that, we also saw the Main Street Lending Program arise out of the CARES Act, And the initial proposal was that loans issued under that program would be indexed to SOFR, but in response to some public feedback, largely from regional and community banks, that was converted to being LIBOR-based loans rather than SOFR-based loans. With all that, there also are some proposed forms of legislation in the market in the UK as far as the FCA goes, and then legislation proposed by the ARC in the States, but there's no way to really determine with any degree of certainty when and whether they will be approved and what the timing impact could be on the LIBOR transition. So something that we're keeping an eye on, but with all of that, we're expecting the transition to play out on the timetable that's been cited all along by regulators. And with that, there are a few things that we're keeping an eye on timing-wise. And to be clear, I believe we're going to distribute these slides after the fact, so this should be available to you afterwards. But we're expecting ISDA to release their protocol and revised definitions and fallback supplement, all of which are designed to accommodate the transition from LIBOR to SOFR, as well as other IBORs geographically and their replacement rates in the UK and elsewhere. ISDA had previously been saying they were going to release those in July and August. I actually just got word today that they're looking to September, and we'll talk a bit more about why a little later on. In addition, in October, there's the expectation that the CME and LCH, the market-leading clearinghouses who sit between banks and other really large market participants on their derivatives, are going to be converting their discounting methodology for purposes of valuing positions and also interest due on positions to stop using Fed funds and start using SOFR. And it's at that point that we expect there to be more of a meaningful risk that could become hedgeable that we expect could start to really kickstart activity in those markets. But I'd say that those are the major events that we're watching. And with that, I'll hand it back to you, Ted.
Okay, thanks. That's very helpful context. On the surface, changing to a different index doesn't sound like that significant of an event. Blake, could you give us an idea of the practical impact for borrowers? So let's start with like existing loans and derivatives, most of which are tied to LIBOR. What happens to those contracts?
Yeah, so existing loans, this is what we're looking at least as phase two. So just to be clear, whether we've originated a loan a couple of years ago or it's one that's going to come through in the next couple of weeks, substantially all existing loans with maturities after 2021 will transition to SOFR. Regulators are trying to minimize the value transfer of the transition by implementing a spread adjustment. So based on the perception of fairness, there's likely to be some winners and losers. And I'll give you an example. If we look at LIBOR today, 16 basis points compared to 30-day average SOFR of 10, a spread added to SOFR will likely be over 10 basis points, which would in effect make your rate higher today than it was as a LIBOR-based loan. However, if we look back to April 1st, LIBOR was 1.02 and SOFR on a 30-day average was 60. So a 42 basis point delta. So a 10 or 12 basis point spread, your rate's still coming down about 30 basis points. That's great for a borrower. It's not so great if you hold the MBS. So there could be some disputes, and LIBOR is a big universe. There's a tremendous number of individual contracts that are going to be impacted. Matt, can I just ask, do you have off the top of your hand what percentage of these contracts overall are derivatives?
It's upwards of 90, even 95%.
Yeah, just a huge percentage of derivatives, a lot in the underlying loans. I think Walker & Dunlop alone has over 500 variable rate loans that are going to be maturing after 2021. So those will be impacted. All the loans we originate, we still do service. So Walker & Dunlop will be in touch. There's nothing you need to do at this point. Each one of those loans likely has a cap or some other kind of a hedge on it. There's likely replacement caps that are being escrowed for. And then many of these loans had an MBS issued, which the owners of those MBS may also have hedges. So it's just each loan has a long trail behind it of other contracts. With respect to future loans, the big question now is how they're going to price. Do investors add to the spread to compensate for the lack of that credit component that was inherent in LIBOR, but not in the risk-free SOFR rate? I think the best example we can look to is recent Freddie Mac K certificates, which The most recent Freddie floating rate securitization had about $1 billion of underlying LIBOR-based loans. They were split approximately 50-50 into LIBOR-based certificates and SOFR-based certificates. The spreads were L plus 36 and S plus 38. So just a couple basis points wider for SOFR. On a percentage basis, maybe 5%. Also, we have to think how these embedded caps will impact spreads on the ARM 7.6 and the ARM 5.5, because those will need to be hedged internally. Even though the borrowers aren't buying the caps themselves, there is a cost associated with the agencies putting the caps on. So we do think that'll flow through in the spreads. Going forward on these new loans, a couple things to think about is the management of settings in advance on the loan, and then settings in arrears on the caps. So there's going to be a little bit of a payment timing mismatch. And finally, what happens when these term SOFR rates do become available? Also, with respect to timing, I don't think anybody's expected 2020 to turn out the way it has. COVID-19 took focus off this for a long time, among other things, but we've seen no signs of delay. And on the contrary, a lot of new developments. If you want a LIBOR-based Fannie or Freddie loan, it has to be under app by September 30th. And if you want a Freddie quote, you have less than 2 weeks to get one, for LIBOR anyway. Either agency, in just over 100 days, we're going to be closing the last of LIBOR-based loans. So Matt, what are some of the issues you've identified on the derivative side?
There are a few things for folks to keep in mind, excuse me, and I've seen some questions come through on the Q&A, so I'll do what I can to address these within the context of this answer. One question folks say is, well, what's going to happen to any swap that I have associated with a floating rate loan? So let's assume we're talking outside the agency space. The biggest thing that I think you're going to be concerned about is the mismatch, or hopefully lack thereof, in terms of the timing and methodology for fallback on your loan, as well as the fallback on your swap. Because again, you swap that loan to offset risk, and you don't want to necessarily give rise to any additional risk within the context of the fallback. And that's going to depend on what the fallback language looks like in your loan, as well as in your derivative. So with that, ISDA has drafted all of the documentation that underlies derivatives, and even for Freddie floaters, there's ISDA language incorporated by reference in essence. And there is an existing fallback methodology built into the ISDA documentation. With that, that contemplates more of a temporary cessation of LIBOR rather than a wholesale transition to a new rate. So given the difference between what the existing language is really designed to do and the market needs now, ISDA is working through this revised documentation to facilitate that transition. With that, again, you've got the question of the perfect match on the swap side. And then on the cap side, specifically on agency floaters, are your caps that extend beyond the end of 2021 going to be worth anything? How and when are the agencies going to ask or require you to transition those? That's something that, as we understand it, is going to be more of a 2021 issue for the agencies, where they're more focused in 2020 on actually issuing loans based on SOFR and getting that program off the ground. But I would say that those are some of the main things that we're watching specifically on the agency side. Another question that we got is what we expect to see in terms of other commercial loans and commercial lenders. We don't think that the agencies necessarily wanted to go first. We haven't really discerned any sort of first mover advantage with that necessarily. So it's our understanding and expectation that other lenders in the market are going to essentially wait and see how things play out on the agency side before moving forward with their own SOFR lending programs. So those are the main things that we're keeping in mind on the derivative side, Ted.
Okay. And as other lending sources begin to incorporate SOFR or not, what are some of the differences between LIBOR and SOFR that they should be aware of that might be challenges or potentially impact them?
It's a great question, and there are a few different ways that you can think about that. So for one, as Blake had mentioned previously, SOFR is an overnight rate tied to market transactions. And to another question that we received, that's the main reason that the ARC recommended SOFR as compared with, say, Fed funds or treasuries or anything else like that. There's just a really, really deep and liquid market in these overnight treasury repo transactions. And I think it was that depth in market, as well as the fact that it's not technically a policy rate, though the Fed is active in repo markets, so we'll kind of save that existential question for another day maybe. That was the big part of the reason that they chose SOFR. And with that, that's part of why they developed these compounding or averaging conventions to calculate the fixing you're going to use for purposes of a given transaction. So when we take a look at the graph here, obviously you can see that daily SOFR is very volatile. You can see in particular the spike that Blake was talking about from September of last year. But then when you look at SOFR compounded in advance, as the agencies are recommending, or in arrears, as the ARC is recommending in a lot of other circumstances, you see that the line becomes a lot smoother. So one of the initial concerns that we've heard is volatility in SOFR markets, but we expect that this compounding feature is going to change it. With that, again, as Blake had mentioned, because there's no credit component embedded within SOFR, the secured overnight rate, as compared with LIBOR, a term rate, excuse me, that's something that the market is going to have to adjust for in terms of the spread adjustment, which is designed to keep the parties economically indifferent. But as a practical matter, I think that's realistically impossible. So the idea is to minimize or mitigate value transfer rather than eliminate it altogether, because I think that's just practically impossible to do. So even with that, the nature of both SOFR compounded in advance and in arrears is based on certain of these historical data points where you need to look back and perform some compounding or averaging rather than look forward out on a term curve like you currently do with LIBOR. So there's a question of whether and when that term curve is going to develop. Excuse me, again, in connection with the clearinghouse discounting switch in October, you're going to need to have a curve that goes out that far in order to adjust those valuation methodologies, and we expect that that could be a step towards developing a term curve. I think that's something that the ARC said they expect to see develop more by the end of the year. Other than that, in terms of the differences between the rates themselves, you can see that we've got the 5-year historical median spread, which is what ISDA and the ARC are recommending in terms of their spread adjustment methodology that we had talked about. It tends to average around 12 or so basis points, but there are different times in the market where the rates can diverge more or less, and particularly in this market environment, depending on how long it lasts, that could also definitely have an impact on what those averages look like over time. But beyond that, there also is, as I'd mentioned earlier, a really significant difference between LIBOR and SOFR in terms of activity in futures markets and swap markets. And there's enough liquidity to be able to develop a kind of shorter part of the term curve, call it 1 to 5 or so years. There hasn't been the activity on the longer end and the swap side that has led to a large degree of comfort to be able to develop that curve. But again, in connection with the clearinghouse transition, that's something that basically is going to need to happen. There was one question we got about what drove the spike back in September. The dynamics in the repo market largely, in a lot of ways, are driven by the Fed funds target range and also by supply and demand in repo markets, which in a lot of cases is driven by banks' need to keep cash on balance sheet. So back in September, there was a pullback in terms of bank involvement in those markets to keep some of that cash on balance sheet in connection with some upcoming tax liabilities and also just Dodd-Frank stress testing and some of the more intensive equivalents, and that was a big part of what drove that spike. There was also a big spike, well, it looked big, and then September happened, but there was a big spike at the very end of 2018, beginning of 2019, driven by the same thing, and you can see that back on the slide here. Again, it pales in comparison to September. But with that, I think the only other question that we get, especially given limited activity in SOFR, is whether we expect to see any of these alternative indices like Ameribor or the ICE Bank Yield Index, some of the kind of spread methodologies designed to capture credit, whether any of those are going to take off. There definitely are parts of the market that might prefer certain of those rates for one reason or another, and Jerome Powell did endorse Ameribor specifically. But with that, the Fed and the ARC and ISDA all are leaning pretty hard in the direction of SOFR. Again, that's also what the agencies have said they're going to be moving to. So I'd say that's what we expect to see folks develop into. I'm curious, Blake, you were also talking about some of the agency products in the past in terms of a floating rate loan with an embedded cap versus a third-party cap. I'm curious, what does current use of the embedded hedge product look like?
So right now we just have the option for the ARM 7.6, which is the 7-year term. And that product has been used, but it's been used sparingly. By far and large, the most popular product we have on the Fannie side is the structured ARM.
That makes sense. And I mean, I'd say that's consistent with what we see, but there is somewhat of a sort of data bias there, given that we're a hedging advisor by and large. But with that, Ted, those are the main kind of things that I would cover in terms of some of the differences between LIBOR and SOFR.
Right. Okay. So lots to be aware of there. Blake, what would you say our clients should be doing today to prepare for this transition?
Well, first and foremost, don't count on a delay. I mean, phase 1 is already here. So I would start looking forward to phase 2, which is getting to know your existing loans. Not just the maturity dates and rates, but what do the loan documents say? As Matt has mentioned, there's a few instances where note holders may have to approve transfer or going to a new index, but there's also some loan docs that only contemplate a permanent cessation of LIBOR. So if we were to get on an outside chance, one of these triggers that were to cause the transition to happen earlier than the end of 2021, some loans may transition over, but even though LIBOR is still being reported, some other loans would have to maintain or have to stay on LIBOR. That may also happen if beyond 2021, some banks continue to report LIBOR even though they're not compelled to do so in what might be called zombie LIBOR. That's about it. Matt, can you share some of the advice you're giving to your clients on the derivative side?
Absolutely. First and foremost, there's really a need to understand what your exposure looks like in terms of how your existing loans are written, as far as your trigger for a fallback, what your fallback rate is, and then how you're going to adjust the spread over or theoretically under that rate. So we've gotten some questions about what could phase 2 look like, given that folks are focused primarily on new loans versus then converting legacy loans. On the agency side, the agencies bear most of the discretion in terms of when and how that transition will play out. There's a concept of what they call either cessation triggers or pre-cessation triggers, meaning are we going to wait until the full, final, and unambiguous death of LIBOR is announced, or could there be certain other events that happen pre-cessation that should be the trigger away from the loan? With that, you've got consistency on the agency side, but across non-agency lenders, both within a given lending class, global investment banks, insurance companies, debt funds, there's a whole variety of language, even within a given lender as it's evolved over time. So I think that's going to be the first thing that folks really need to be able to understand. Secondly, then you want to understand what fallback is going to make sense on the derivative side, because the nice thing about the approach that ISDA is advocating under the protocol is that it's really efficient and easy to adopt, and I think that lenders and swap providers are going to want folks to just utilize that because it's really straightforward, but the fallback methodology there may not always be the best one, so to speak, based on your specific circumstances and how the fallbacks in your loan are documented. So again, I think understanding those is going to be most important, at least in the near term, to be able to figure out what your transition looks like. And then other than that, you want to make sure that your systems and vendors and models are capable of accommodating SOFR, especially given that it is a backward-looking rate that requires observation of a number of periods before determining a specific setting. Systems just need to do things now that they haven't really had to do or haven't had to do at scale in the past. So you want to make sure that everything has been updated and is capable of being done, I guess. And then in terms of new agency loans that you're contemplating, to the extent there is a choice between a LIBOR-based cap and a SOFR-based loan, or a LIBOR or SOFR-based loan, there are different considerations that come into play there, and they're the sorts of things that we and Blake and Ted and the team would be more than happy to help you think through.
Okay, so definitely some moving parts there. So what's the next announcement or development each of you will be looking for coming up here? And let's start with Matt.
For us, it's definitely the ISDA protocol and related documentation that they're going to be releasing now, it sounds like next month. Following that, it's the clearinghouse switch, which happens in the middle of October. I'm hopeful that we'll see the ISDA docs before then, but in any case, those are the two biggest changes that we're keeping an eye out for. That and the first purchase of a SOFR cap on an agency loan, which we'd imagine would happen by the end of the year.
And I think for us, it's as we're entering phase one, final product term sheets out of both Fannie and Freddie, gauging investor interest on the Fannie Mae side, and finally getting a sense of pricing from both agencies.
Okay, sounds good. We have had some additional questions along the way, so we'll go through a few of those now. First is we had several questions about Ameribor being a likely alternative index. So Matt, would Ameribor be better for some market participants?
I think that regional and community banks, and Chatham does some work with some of those folks, they seem to express a preference for it, I think because it provides a better kind of asset liability match, or is more reflective of how they fund themselves, I think, than they feel that SOFR is. With that, it hasn't gained the what I would describe to be the kind of market-wide adoption and push that certainly that the folks over at AFX would hope it would have. I don't think any possibility is foreclosed because SOFR is a recommendation but not a requirement. And with that, SOFR has definitely taken some dings over the couple of years since it's been produced. So it's conceivable that activity in other rate markets could grow. With that, our expectation is still that SOFR is going to be the more predominant rate, and that activity in Ameribor could be more akin to, say, prime in terms of volumes. But again, that's going to remain to be seen.
Okay. Let's see. We've also had a few folks ask about how the transition would impact construction and bridge financing. One specifically regarding the potential impacts to LIHTC markets. Blake, any thoughts regarding how construction loans will look?
Yeah, so when it comes to construction, our primary focus is on the HUD 221D4, which offers a really attractive fixed rate, right now somewhere in the neighborhood of 325. And also on the LIHTC loans, we offer some unfunded forwards, which we could rate lock today for that permanent takeout in a couple of years. Also a fixed rate. But for the underlying construction loans, and this applies to most, it's smaller and regional banks in large part. Some of the majors also, of course, but for those, SOFR's not, or for anybody, SOFR's not really a requirement unless the regulator says so. So a lot of these banks will be able to choose whether it's SOFR, Prime, Ameribor, as Matt had mentioned, or anything else that fits their needs. At the present time, many banks have not yet indexed to SOFR. We've heard that some have, but almost all should now have fallback language incorporated into their loan docs that allow the flexible use of an alternate index. Some banks may continue using LIBOR as long as it's published or until a regulator tells them they're no longer allowed to, but may approach those with some caution as we get it later into next year.
Okay. Let's see. We also received a couple questions about how the transition may affect long-term rates or how a vaccine might impact rates. So Blake, any predictions on rates over the next year? How's that crystal ball looking?
I don't think we really want to get into the business of predicting rates, but I will say that the Fed has signaled near zero rates through the end of 2022, which is, making for a great time to be transitioning from SOFR to LIBOR. This would be much more difficult probably if we were in a tightening cycle or an easing cycle. So it's a great time for it. But, as far as rates go, once the fundamentals really improve or we get a vaccine that's proven effective, given the Fed policy, I think we'll see, a bear steepener is pretty likely where short-term rates stay low as they are and the longer-term yields rise a bit. But I'll just leave it at that.
I'll just add briefly, Blake, that I think your point about what the Fed is signaling is particularly germane to SOFR, given that SOFR is derived by activity in the repo market, where the Fed has the ability to, be really active and often is, as we've seen at various points over the last year and a half. So I think that much more what they're communicating through the target rate, you can expect that that's going to carry through to how they engage with the repo market, which then is going to have an impact on SOFR.
For sure. Yeah.
All right. I want to thank everyone for joining us for our discussion today. There are clearly big changes ahead and lots to do to prepare for them. A number of items we have discussed are evolving, and so we will be providing updates as they become available to ensure that you and your businesses are able to smoothly manage the transition from LIBOR to SOFR. If you have any questions along the way, please do not hesitate to reach out to your contacts here at Walker & Dunlop and at Chatham Financial. And with that, I want to thank Blake and Matt for sharing their insights on this topic. I also want to remind everyone to join us tomorrow at 12:30 p.m. Eastern Time for our Walker Webcast. Willie will be joined by David Ignatius, Associate Editor and Foreign Affairs columnist for the Washington Post. Thank you again for joining us for today's webcast.